Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. In this hour-long casual conversation, I chat with Claude Walker, founder of A Rich Life. You may know Claude from Twitter or from a previous Australian Investors podcast that I did with him. In this conversation, Claude and I talk about management. In particular, some of the subtle and more explicit signs that you can pick up on as an analyst when you're investing in small cap companies on the ASX. This conversation is pretty fast and loose, but it's just a casual conversation from two investors just trying to get better at analysing management. I hope you enjoyed this conversation with Claude Walker from A Rich Life. Mr. Claude Walker, thanks for taking the time out to join me on the show again, mate.
That's great to be here, Owen. Thanks for having me.
Yeah, today we're going to talk management, we're going to talk incentives, and everything in between. I've had you on the show before, and many of our listeners will know who you are from Twitter or from the stuff you're doing over at A Rich Life and from former roles. But maybe for those newer listeners, because our audience has grown quite a bit since I had you on the show last time, mate, why don't you just tell us a bit about yourself and a bit about A Rich Life? Like, what are you doing over there and what's the general feel of it?
So A Rich Life is sort of aiming to be a sort of different version of the AFR, covering sort of news, arts, culture, and then business and finance and stocks. But because there's, a lot of coverage already in sort of like the big companies in the Commonwealth Bank and BHP and that kind of thing, we, rather than sort of try and compete with an area that's already got good coverage and multiple different points of view, we tend to focus more on the smaller end or the medium companies as well on the stock market. And the simple reason for that is because, there's fewer people writing about that. And that's there are plenty of people still that are interested in those companies, though. So that's what we aim to cover.
And we'll get to, I guess, the kind of choices that investors have for their news flow in Australia in a moment. And yeah, let's just say there's a lack of good quality information. I'd say even if you go below 500 mil market cap in Australia, there aren't too many decent publishers out there that give you what you want. I mean, there are quite a few data providers. So you can get data that's been scraped or high level stuff, but it's pretty hard to find good quality information the further you go down. I find fund managers are often a good source of insights because, they're willing to talk about positions. But anyway, I digress. So, Claude, I'll encourage people to go back and I'll put a link in the show notes to the other episode we did where it describes kind of how you invest and why you invest. But a lot of people that follow you know that you like small caps and you have this, focus on, we can say ethical investing or ESG investing. And today's discussion is kind of about how those two things come together and why they come together and why they work. And I know you've got a heap of examples that we can load up on to kind of hit home these points. Maybe I'll just give you an easy one. So why small caps, mate? I think you might have answered that before, but why small caps?
I love that question because if you haven't realized this yet, it can be a sort of aha moment. And that is that there are many fewer people looking at small companies. And that means that there's much higher potential for you as an individual having an insight that really does give you an edge that allows you to value and understand the worth of a small cap company better than other people. And I think this is, touches on a subject I want to get into later, but every single person has their strengths and weaknesses, and anyone as an individual investor may have strengths that allow them to understand a smaller company much better than the overall market. And that's where people can make money based on their expertise. And if you cultivate a particular interest in this area of the market, you can maximize that advantage. And because the fewer people trading in these stocks and fewer people understand these stocks, it's just a less efficient market, and so there's more potential for mispricing. So that's why I initially started in small caps, and that's all just based on Buffett and all of, plenty of people have made this point. But because I'm just a small person, like a small investor, I definitely want to maximize that advantage, and that's why I choose to look more at small caps.
Yeah, I love it too, because oftentimes the business models are simpler, right? One thing I think you told me many, many years ago, this is a throwback to like when we were at the Motley Fool. You said to me that, oh man, you should focus on small caps because you can get your head around the ideas pretty quickly. And even to this day, I don't know if it's got better or worse. Like we have great platforms like Strawman, right? Where you can go on and you can share your views on smaller companies as an investor. But I don't know if it's getting any more efficient. Like I feel like it's still a bit, and we'll talk about this in a minute. Like it can still be a bit like the Wild West. But at the same time, that's why you go there. Like if you have your wits about you, it can be a fertile hunting ground. But I guess the key point is like having your wits about you, which is what we're going to talk about here. So why do you kind of intertwine the focus on small caps with, we can say like ethical investing or ESG? Like how do those two combine to make something special for you?
In answering that question, I can't avoid the fact that initially what I wanted to do was be part of the sort of renewable energy industry and to manifest more environmental energy sources. And I actually worked for a solar company for a while back in 2013 after I graduated. And then there was a change of government and basically a lot of renewable energy activity shut down. So I was really just trying to respond initially to my frustration that there was all of this cool stuff we could be building and doing in demand side management and batteries and solar and all this sort of stuff. We could have done that in 2013, and I wanted to be part of that and work on those deals and learn how to get grant funding or however it worked. But basically, that all just sort of got shut down for political reasons in Australia. So I wanted to try and be part of the solution to that lack of funding. And one part of ethical investing is saying, oh no, maybe we avoid tobacco or guns. But another part to me is we should push money towards constructive uses, such as things that make people's lives better and make the economy more sustainable. And so that's why I initially got into investing. So that was actually the first step to like investing for me, or the first impulse. Now I had, of course, dabbled in shares prior to that, but even before I dabbled in my first shares, which I think we talked about on the last podcast, basically it was like I wanted to push money towards good things that I believed in. And then, of course, in order to be able to influence money and to grow your own capital, you need to, know how to do so in a way that that increases the capital base that is influenced by you. So you need to be helping other people understand the world better in a way that they can then use to equip them to become more influential and have more capital. So my thinking is if I can talk directly to the people that want to make a better world and try and increase their power in the world by giving them the tools they need to invest themselves, then that will be the best impact I can have to, advocate for a cleaner economy and other things that I believe in.
That's a really interesting way to frame it, kind of just it being an enabler. And that's, if you go to
an adaptive enabler, that's actually an investing concept, but it's also what I want my business and my life to be doing in the economy as well. Yeah.
You want to be proud of it, and I guess a rich life does that now that you can bundle like the arts, culture together with investing. I think you can intertwine them so well. Okay, so one of the things that you and I have talked about, and we talked about this today and yesterday, is this idea that in small caps, you can, by even directing money to companies that you think are doing good or avoiding doing bad, you can invest alongside great management teams. So management teams that are incentivized for long-term outcomes. These kind of, I guess you call it conscious capitalism, where there's many stakeholders, not just the shareholders, in some of these, in the minds of some of these management teams. And we've got quite a few really good examples here, mate. So in small cap land, not many individual investors know this, but the access to management is often pretty good. So if you send an email off, you might get a reply if you word it correctly. Whereas in large cap land, it's harder to get exposure to those management teams. So I guess this conversation is going to be a bit wide ranging, but let's just start off with like why management is important in a small business, and then we'll go into the good and the bad and the ugly.
Yeah, great. And I think you've touched on a lot of the advantages of looking at small companies, but now that we're there, now that we actually, for example, have access to management, even as just a small investor that's starting out, I know many good CEOs who've replied to someone who was just starting out and earnestly had a question. They tried to answer their question, and they also just looking for guidance from the CEO. But how do we then use that position to be better investors? There's a lot to think about, but I think that I'll make the final link to ESG, which is, I think if you're starting out as an investor and you want to invest for long term, it's an advantage again to focus on ethical businesses and stuff like that. Because think about this: if the CEO is the CEO of, say, Pro Medicus, and they're trying to sell this software that they want radiologists to trust with their patients' well-being, it's important for that company to put medicine first and have that like correct healthcare ethos because they're interacting with doctors and doctors are the buyer. But that's not just true of Pro Medicus. That's true of, and I think everyone knows this. This is my largest shareholding, which is why I use this as an example. But it's true of any healthcare company. If, for example, that is interacting directly with doctors and nurses, like you've got some people that really care about the patients that may be, really involved in the decision here. So I do think healthcare and healthcare technology, as long as it's a real business, is actually a good place for beginner investors to look. But it could be anything that, as long as the company is like, got a high-minded ideal that makes sense, that could be a better company to look at and to start with, because you're more likely to be steered in the right direction rather than misled by management.
But then there are so many instances, right, where people do get these ideals and they stick to them. Like, let's just think about like biotech, right? Like how many small cap biotechs out there that are just absolutely rubbish. But they're like, we're going to cure this, we're going to cure that. And they're just promotional CEOs, right?
Exactly. So that's the other thing to remember about ESG. I'm glad you brought that up. Is like, if you go to investing purely because like, oh yeah, I really care about green tech, I want to find this, renewable energy company. There is somebody also waiting on the other end then that does not have a real business, who's just going to sell you an idea and take as much money from as many people as possible. So, you have to be absolutely certain, and this isn't even to do with management, you have to be certain here that you're actually investing in real businesses. So, that's probably a good thing to mention too, is there's some assumed knowledge in the discussion we're going to have about how we might look at a company and use the evidence to make judgments about management. I think it's important to note that there's some assumed knowledge here, which is that you're investing in companies that have real products, that have real paying revenue, that revenue is manifesting in actual cash flow, that you can verify there's a real product. And this is all, that's really all important stuff. But then within that, even once you have a real business and all that's true, then you have this big range of other terms that we're increasingly using and that we are relying on management for. So a good example is things like annualized recurring revenue, subscription revenue, contracted annualizing and annualized recurring revenue, etc. None of these terms are necessarily audited. I think some of the revenue terms may be audited, but a lot of these terms are just management figures. And in any company, but especially small caps, when we're looking at these figures, we need to essentially, whether management is being conservative and reasonable and trying to give an accurate picture of where the business is at, or whether they're trying to always give the best possible interpretation and make the numbers look as good as possible. It's very important. Like the nature of management and what we think of them is extremely important in any analyzing companies, especially small companies, when the difference between actual revenue, that is the amount that they can book in the audited books, and say contracted annualized recurring revenue, might be quite large. And, in this day and age, we've got people doing some pretty fast valuations, just, multiplying revenues to try and get, valuations. That's pretty dangerous if you start relying on sort of management underlying revenue numbers. And lots of companies, almost every company does have sort of management numbers they present. So I'm not discarding these numbers, but I'm just saying that even if we're going to look at these numbers, then who management are and how we think of them definitely becomes important, even when you're looking at the numbers. And I guess that was why it seemed like a good subject to focus in on for this chat.
Yeah, two things in that. We're assuming some knowledge here, right? Like we're talking about management of companies and like legitimate companies that have business models. I did a great podcast, a chat with Luke Winchester, who I know you know, about kind of ways you can channel check, and we talked about last year or the year before about how you actually get information on small caps and the difference in that research approach. So we're assuming that knowledge for this podcast. So the other thing is, like, I think you said to me previously that small management teams, like in smaller companies, management can kind of have a bigger sway because they're not like run by corporations with many thousands of investors who can get a board to vote out a CEO, etc. Sometimes these people are ingrained in this business, so it's even more important. But there's one thing in this, Claude, and one thing that it's kind of one of these angles that you need to understand if you haven't been in industry is that where the incentives also lie for the researchers. So we found a company, we're looking at the company. One of the things that people do is they often go to a research report by a broker. Why do you, like, I'm not going to plant the seed here, maybe I'll let you go for this, but are brokers a reliable source for, I guess, an assessment on management?
Yeah, so a lot of actual stockbrokers that work for the big firms, they're actually really savvy and they do know a lot of stuff. That, I guess, it depends on the broker. But I guess what you're asking about is in particular broker research, especially since people are emailing that around. Even sometimes you might just see a little excerpt from broker research on either quoted in an article or even on Twitter or something like that. So that's a good question, and I think that the reality is that you definitely need to be aware that what brokers cover may depend, especially in small cap land, may depend on whether they have other business relationships with those companies. So what you do tend to see is that if a broker like raises capital for a small cap company, then they're obviously more likely to provide coverage of that company, which just makes sense. And they often do have, a good understanding of the company. So it's not that I would mistrust broker research, but at the same time, especially for companies that are either they're burning cash and they're really going to need money, but more likely, they want money to grow and stuff like that. These firms, especially once there's sort of 2 or 3 firms covering them, they sort of do have an incentive to say nice things about the company for multiple reasons. But part of it is just because, they know that they're going to be probably in a position where they're going to be wanting to raise capital for the company. So it doesn't make a lot of sense for them to be super harsh on valuation, does it? Because the best thing for existing shareholders who are also their clients is if they raise at a good fair price to existing shareholders. Now, there's nothing wrong with that, but it's definitely worth being aware of that dynamic.
Yeah, and this is like kind of like follow the incentives type thing as well, right? Like if you and I come out and say something, there's not that much recourse for us as kind of independents, but if you have that relationship, there is, right?
Yeah, well, so that's the other thing we're thinking about, and I think maybe this leads nicely to the first little example of the things I use to help shape my impression of management, which is you get these earnings calls, right? And often the people the analysts that ask questions on earnings calls, their firm are the firms that cover the company. They may have done the IPO or something like that. And I had an interesting story which can just let people into my thinking that I can share, which is this new sort of IPO of this sort of retailer called My Deal. And essentially what happened was I owned shares in this company because I just thought just a small position just because I wanted to follow along with it. It seems like an interesting online retailer. It had, got some hyper growth, as a lot of them have in the COVID period. And so I bought some shares and I'm following that along. And then I dialed into the earnings call and basically, listen to their presentation. And then I had just one little question. It wasn't even a hard question. I don't recall precisely what it was, but it was just, something to do with their sort of funnel because, these guys sort of, they have the business model where they try and get as many users to have at least one transaction as possible. And then they've got the email address and then they send you marketing and stuff like that. So similar to Kogan and all that sort of thing.
Yeah.
And, the operator, so I asked a question and then it went through and then the investor relations people emailed me and said, oh, we'd be happy to chat to you. We'll organize a chat for afterwards. And then the operator was like, oh, there are no further questions. And then, ended the conference call. And I did have a chat with the CEO and it was a good chat. And, I thought he seemed really great, but I still was just so shaken by it just put me off that they hadn't taken my question on the call and that they just had some it felt very stage managed, I guess. So I actually ended up selling my shares in that company. I only had a small position anyway because I was just interested. I didn't have any conviction behind it. Now that may prove to be wrong, but I would have gotten a lot more comfort, and I might buy shares in this company again, but I would have gotten more comfort if I had heard me and even some retail shareholders or ideally, anyone from the peanut gallery to come and ask the CEO questions.
Yeah.
Even if some of those questions weren't so good, just because for me, that is a heuristic of good management. And I'll give you an example of the opposite. I remember Nanosonics, which I do own shares in to this day, many years ago when I first covered it for Motley Fool Hidden Gems. The share price was, $2 or something, around $2.20 or something like that, 60. And it was still a decent sized company. And the CEO would take questions for the full hour. They'd do their presentation and then they'd go pretty much for 60 minutes. And they had a lot of questions from analysts. But even back then, while they're a decent sized company, they'd have a few questions from shareholders or, just whoever called in. And that was sort of really interesting because you get some out of left field questions. Some weren't so good, but some were interesting. And it gave an opportunity for shareholders who'd done a little bit of research and had a niggle about the company to actually put what to them might be a hard question. So yeah, and on top of that, I guess, I'll leave it at that actually. But yeah, that's an example of good and bad to me.
So why is some people don't know this, but we know this. If you listen to some of the big blue chip companies' calls, you probably get the feeling that this happens. But operators will actually screen calls and choose questions that they prefer. Obviously, they can be selective because they have so many coming through. But why is this idea of set questions? So questions that are kind of the management want to answer because it's fluffy and it's lovely. Why is having anyone other than the transparency, why is that a good sign for management, I guess, integrity?
Oh, that's a tough question, and I'm not quite sure I understood it correctly. Can you rephrase it?
Yeah, sure. I think the way you put it to me previously is you like to see unpredictability in questions and management
exactly
embracing that.
Yeah, well, exactly. So it's just the willingness to take random questions that I have found to me has correlated with companies that have generally had been, in my view, also well managed. And I'm sort of grateful for when I have been covering a lot of different companies. There's been a lot of questions I've asked at AGMs, for example, is a good opportunity. In non-COVID times, I've been keen to attend AGMs with different companies just to ask a few questions or whatever. And that kind of unpredictable environment tells you more about, I guess, the people involved. How do they handle a crowd, especially a crowd that is there partly to like ask antagonistic questions because they want to give them a run for their money. And that sort of stuff is great to see. And I want to see management to sort of embrace that more and do less, I guess, stage managing. And we're talking about small companies here, right? Like there's definitely a time and a place for companies to have like organized systems. Like Commonwealth Bank can't have the sort of an unstage managed AGM. But because we're looking at small companies, it's sort of interesting to see where they're at with that. And it should be pretty obvious to anyone that you have a better opportunity of, getting an interesting insight when a manager is like answering something unexpected. Then the other thing is, just as a matter of integrity, wouldn't it be the best thing is when you've got sort of fluffy questions that you would like to answer, I think you can just publish a sort of Q&A and sort of have your investor relations person, ask those questions and just publish that as part of your materials and then have the random questions come at you would be the ideal thing in my view. But you don't see that sort of stuff too often.
Yeah. There's speaking of variability, the variability in the way management answer questions is marketed. There is so many, CEOs out there who are truly passionate about a product, right? And they love to have different questions because it tests them, and they're kind of on the fly. They're like, oh yeah, but this is how it relates back to our core values. Like I'm thinking of the Okta CEO, and I just love the way he presents. Todd McKinnon, it comes back to like first principles, and everyone can understand it. But then you get some CEOs that just flat out deny talking, or answering questions at all. Maybe I won't name names. Part of our small cap research service, the Rockets program, we have a CEO. We tried to interview all the CEOs and publish them for our members. And one of them said, we don't talk to investment clubs, without even hearing what I had to say. Just said, we don't talk to investment clubs. And I guess just the respect is an important one. Like, we are co-owners in your business. So we deserve to speak with the person that, has our money. And not enough people think like that, I reckon. Yeah, go on.
That's just a brilliant segue, what you just said, into one of the other companies that I wanted to talk to you about. That's an example of how, spotting bad management can make you money, but on the flip side.
Okay.
So if you're up for it, we could talk, because what you just said then about was this example of when you tried to reach out to management and they just wouldn't talk to you, right? Mm. And that reminded me of an article I read a few years ago about the previous management of Coram Group. Oh, yeah. And it was the fund manager, Carlos Gil of Microequities, wrote an article. I think it was published on FN Arena maybe. And he basically, those names, that may be wrong details. We'll check that and correct it in the notes if it's wrong. But basically, that article was saying, he wouldn't like this company because, management wouldn't speak to him. Mm. And I wouldn't have a golden rule that says if management don't speak to you, then the company isn't good. But I would say that, in that case of Coram, like management was not in a good position at all. Like, what happened with that company is that it was 57% owned by the one major shareholder who had just complete control, and one of his associates was running the company. And they were just running this software company, by the way, which I now own shares in. They were running this software company for cash, like basically trying to max out on dividends. They had a pharmacy software product that had, previously, I think, market share of around 40%. During their tenure, this went from around 40% to 20%. So this company was going backwards. It had like a really good market position, and it was just being like run into the ground. And it wasn't until, more recently, like last year, I think, that a different group of that big major shareholder was finally diluted out of being in control, and then the board sort of changed and new management came in. And now, and I think, at that point in time, if you'd bought in, just around the time that was happening, the share price, I think I'm just checking as we speak, was around 4 cents maybe.
Yeah, it looks like
it. Or even lower. And then there was sort of this management change, and they also made an acquisition, which looks to be interesting, and basically they're going to attempt a turnaround. But what I did and what other people did is basically, if you had spotted the fact that this was a decent business years ago, but had recognized that the issue was that the management had the wrong strategy, to say the least, then when you saw that change of management, and I was a bit slow on the uptake here, but when you saw that slow change of management, that should have been a sign. That could be a sign that's essentially, hey, there's something has happened and it's not reflected in the price yet. And it's certainly not reflected in the results yet, because management have only just, changed. So how can they immediately get the results heading in the right direction? But, I did buy shares in that, and I think I'm up, around 100% in not that long. I wish I'd gone in more volume. Maybe not 100%, I'm saying up about 50%. But either way, I still think that this could have a long way to play out. But that's an example of spotting that the management, in that case, was a bit of an issue for the business. That is, essentially, they didn't want to engage with external shareholders, and they had their own priorities. That's a key insight that can be useful later on.
Yeah, I think is it Peter Lynch? I could be totally butchering this, but I think he said you want to own companies that even a monkey could run, because sooner or later one will. And there's that one, but then there's that from Pat Dorsey.
Just on that one, I guess when I hear that, I sort of think, well, you also want to be able to spot when that management change happens, and probably just sell when a bad manager comes in.
Yeah. And we'll get to some ideas in just a second. But then the other one was, the other, I guess, analogy is from Pat Dorsey, who says, like, you can focus on the jockey or the horse, but if you had to pick one, you'd probably go with a good horse, because at least it will get you somewhere. That's an interesting thing. So, like, it kind of was a state of play that needed the shareholder to kind of get booted for some change to happen. I had Mark Tobin on the show, who I know you know, and he was saying that too much is too much in terms of, like, insider alignment. So we talk about skin in the game a lot, but he was saying, I think from memory, like, if you get over 30%, then you have to really question, the insiders, and really have a good understanding of how they're going to treat smaller shareholders, because, what is their incentive? Is it agency, or is it long-term value creation? Do you have a view on that?
Yeah, well, I think Mark is spot on. And actually, like, in the early days of my investing, I remember, like, in a very rudimentary way, surveying the performance, long-term winners, and looking what the management holding was in each case. And in that sort of anecdote, in that very sort of anecdotal, not big data way, I remember sort of drawing to the conclusion that it was best to have, the person running it sort of somewhere between, 20 and 40%, I guess.
Yeah, right.
Although, truth be told, a lot of my biggest winners and my best ones personally, a management, or at least a duo or a family, or a very few number of people have essentially had more than 50%.
Yeah.
So, I don't think you necessarily want just one person single-handedly having 57%. But if there's a couple or three that do, then, I think you're in a pretty good position there as well. So, yeah, that's sort of my view on that.
How about...
I'm definitely willing to invest when a few people have easy majority control. But of course, that's when it becomes absolutely key to sort of think about, what people are doing and whether you trust them. And, also what, I guess, like, the direction of their trading is. So if they have, it may not be very useful information that somebody has 60% of their company left when it IPOs, if, they're actually just in the process of getting rid of that last 60%. So, yeah, that length of holding, for example, would be an interesting one as well.
Yeah, true.
To add.
You brought up a company recently, which might go back to, like, kind of the more so the management side of things, and, like, making that judgment. And this is like the accounting meets management analysis type thing. And there's a company called Urbanize.
Yeah, that's right.
Yeah.
So that's basically one that I wanted to talk about, because it's this play that is like the management change play, but that's one that's sort of played out a little bit already. So if you looked at the chart of Urbanized long term, this thing went from like well above $1 to like 3 cents or whatever. And I come scarily close to actually recommending this when I was when I was an analyst or advisor at Motley Fool Hidden Gems. But then what I spotted was that they had this weird accounting situation where they were bringing in the revenue ahead of the cash flow, essentially. So they were booking as revenue, money that they had not yet received, but had, I guess, contracts to receive. And this was just like making the results look way better than they really were. So that was that weird accounting trick that they used, prior to the share price crash. That was, and just around, like they used that essentially for around the IPO period and the escrow period for the big shareholders, and then it just made the results look artificially good. And that was the tell for us that basically not to trust that company, and that was why I avoided it. And then actually I did buy some shares in this company at one point. I sold them subsequently, but this thing went down to from 50 cents actually. Well, I swear it did actually get above $1 at some point, but maybe my memory is mistaken. Yeah, it did. So yeah, it went up above $1, and then basically, none of the cash flow from the cash flow from all this revenue didn't come in. They end up writing off a bunch of stuff, and their share price goes down to like 3 cents or whatever. They have a little bit of a board change, some of the same players involved still, but also, the key thing is the management team gets out. There's a new CEO in. The new CEO is talking a much different game, talking about getting it cash flow positive, buying shares himself on market. This was the buy signal, essentially. And sure enough, it's doubled since then. I think it was 2019 that buy signal sort of came, or 2018, but as late as 2019, you could buy it at like 3 or 4 cents, and now it's 8.5 cents as we're recording this right now. And that's one that sort of I'm still holding some shares at the moment because I'm sort of interested in how it goes long term. But in large part, my thesis has played out now. So this company now, previously it was talking about getting cash flow positive and all that sort of thing. Now it's changed tack again, and it's going back to how it wants to burn cash and grow revenue as fast as it can. Which the market might like, and it might succeed or it might not, but it's not really the thesis that I initially signed up for. So I have been exiting this investment now, but it's just to me, like the returns on that was totally satisfactory. So that's an example of, how just following a change in management and spending the time to get to know who is the new crew and all that sort of thing can be a valuable use of time. And in this small cap land, having a new group of people that have got a better strategy that the market likes more can make a company, make its results look better, but also make its share price re-rate. That's what you go for.
Did you, with that in particular, do you look back in time at where the management have been before and track them through time? Like, how do you make that assessment? Like, it's great to say like, oh yeah, we're going to be cash flow positive now, as opposed to this guy that just blew it up. But then how do you actually make that assessment to be, yes, I can see what you've done, or, I like you.
Yeah.
Here's my new thesis.
So definitely I do that. It's important to look at not just management, the board members. In the case of Urbanize, this is testing me off the top of my head, but I'm fairly sure that the CEO now had previously worked maybe at a customer of Urbanizers. I can't remember, but it was somebody, very adjacent in the industry. So he definitely knew what he was getting himself into, and he was sort of senior at another company, but then this was a step up for him. So and then he it just seemed like the kind of person. And look, the results have been better since he's been in charge. The board changes wasn't as sort of comfortable with. There was still a lot of the same or similar players that had been involved. So I don't know exactly what the direction is or how to reconcile the sort of very bumpy history with that. Obviously, the difference was these guys, there was like private equity and stuff involved before the IPO. A lot of them were sort of selling around the time of the IPO, or at least certainly not buying. But this crew that had sort of been sort of involved for ages, they were the ones essentially that recapitalized it at 3 cents or 4 cents or 2.7 cents. I can't remember exactly, but really at the lows, they were the ones putting capital in, recapitalizing the company after it sort of crashed down quite a long way. Hey. So you could definitely say that they were aligned, and that is sort of consistent with my thesis. Like, these guys were fully aligned at this price, and then you actually had sort of a substantial shareholder who was sort of in at that price, or buying at that price. You sort of had that shareholder selling out a little bit of his shares, and not that long ago when it was more like 7 or 8 cents there. Yeah. So, that's sort of stuff I look at as well, for sure.
Yeah, and so for people that maybe are new to small caps, again, when we say signals and we're talking about these different factors that we consider, it's not just, CEO's been buying equals good. It's not as simple as that. Like, we talk about mosaic theory, and we talk about, building the picture of what the company is and its investment thesis and your I guess objectives for that company, and that then informs your modeling. We're saying the same thing about management. Claude and I are just talking about some of the different factors you might consider and how you can think about them. There was one other thing here, but it kind of slipped my mind. I guess it was around the question of, like, I see in small and mid caps quite often, is it's often a founder that's like what I would call a financial CEO, a financial CEO, a financial management team. So someone that isn't necessarily a technical lead. Which always kind of, it kind of, as someone who started a business, I kind of get concerned by that. But then I wonder, does that really matter? Does it really matter to you to have a technical person in charge?
So having a technical person in charge is certainly something I look for, especially depending on the size, but especially in smaller companies. Sometimes you do see smaller companies that have, I guess, like, the person in charge is the person that, like, knitted it together and is, like, more of a deal maker rather than like somebody who's like an expert in the area of industry or service that the company is in.
Yeah.
And I don't generally like that. Now, sometimes you get sort of okay results in those sort of situations. As long as everyone's sort of adequately aligned. But no, that's not what I prefer. Like, when I think about the companies that I'm most happy, well, it depends, I definitely like to see industry expertise. It's that simple. And I like to see ideally either a CEO or COO who is, like, got clear operational expertise.
Yeah,
for sure.
Yeah, sometimes there is a case to be made for, like, there are certain horses that require certain jockeys, and there are companies that need to raise capital, so you need a manager that is a bit of a hustler. But sometimes if you're looking at companies that their sole aim, like a Xero in the early days, is to delight their customers, you want someone that understands the problem set, right, and, like, gets it. And I find that is more common in a technical lead. So there's another company that I know you've written about recently, Claude, and it kind of comes back to one of the things that most people think about when they think about judging management, and that is incentives. And it's a kind of I guess it's an indirect way to deal with this issue and talk about something else. But I know there's a company on the ASX you've written about recently called OneView Healthcare.
OneView, yeah. It's been on, I guess, we had a chat about it yesterday, and it's interesting because it really goes to, gives an insight into, like, the very industry we operate in. And I think that the story of OneView itself isn't necessarily super remarkable, but for the listeners, I'll just say, so OneView is a company that does sort of healthcare nurse interface systems. It's like their OneView box or whatever is a thing that gives you the nurse call and tells you a meal about your hospital stay or something like that. They're far from the only offering on the market. Look, and none of this story is really about OneView as an investment prospect. Its history, which is there for anyone to see in the long-term chart, is it floated, great promise. Its share price, I think, was above $5. Then, whatever, didn't deliver. Now share price was below 5 cents. So that's a minus 99% thing. Maybe it's got too low now. It's a real business with real revenues, from what I can tell, at least from just looking at the statements. But it does lose a lot of money.
Yeah.
And yeah, basically, what happened what's interesting about it is the blatant new financial advice business model that caused its share price to skyrocket from 8 cents to where did it sort of close, like above, I think it got to a high of 22 cents or something like that.
Yeah, I think it even went up again today as we record.
There we go. So now it's 22. Now it's back on the fly. So what happened here, and this is the really interesting thing, is, essentially the timeline, and you can find actually the timeline in an article on A Rich Life if you just
I'll put a link in the show notes.
View A Rich Life, yeah. But basically, there's this company called the S3 Consortium that did a deal with OneView, and the way it all played out was that the first thing that happened is S3 Consortium, who owns the Next investors, they first got shares from OneView. They had an agreement to get over 6 million shares in lieu of 375K as consideration for using Stocks Digital to share its research, commentary, and investment thesis on the company being OneView. And on top of that, S3 Consortium and other investors in the S3 Consortium network were going to buy 16.66 million shares at 6 cents per share, which was under the sort of share price of 8 cents when this sort of thing was announced to the market.
Claude, can I interrupt? I'm just going to bring some clarity to this. So we've got a listed company, a company on the ASX. It's called OneView. It does health software. And then it made a partnership with another company, S3 Consortium, but it goes by the name of Stocks Digital. And it has a bunch of these websites that talk about stock markets and investing.
Yeah, we should.
Stuff like that. So there's there's two parties. There's the listed company, and then there's the publisher.
And the publisher, this S3 Consortium, that has a whole network of sites that they actually own. I think that sort of the main brand is Next Investors, and they have a sort of scorecard page of all of these stocks that they've released reports on, and they basically say invest alongside us. And, basically encouraging people to get on board with the stocks that they're already long. Now, I'm not quite sure about all of the companies on this scorecard, but I know for a fact that when I looked at it yesterday, the scorecard showed our entry price as 8 cents for OneView, but actually they got in a bit lower than that. So that was sort of the first a bit weird thing. And then what ended up happening was, the market announcement goes out saying that they'd done this deal, but they had already sent out to their investors, their people there, I guess you'd call them clients, even though they're not paying money. They're just getting the free emails from Next Investors. They send their report that declares OneView Healthcare to be its 2021 tech stock pick of the year out to their whole sort of database. And then when the stock opens, it opens above 14 cents. So it's jumped from 8 cents, pretty much no volume in the stock, hardly any shares traded, just over averaging just over 1 million shares per day at, 7 or 8 cents. And then this explodes the next day, starts trading up at 14 cents as all these people receive this email and rush out to buy this stock. And that day, over 270 million shares trade. And the share price, gets up to, I think, 20 cents and closes at 16 cents or whatever. And then we have the weekend. And then the next Monday morning is sort of round 2 of this mass email thing. And this is not all the places that emails came from. If some people got emails that I don't mention, please send them to me for the archive. But they got second max emails from at least 4 other sort of organizations, and you can see what they are on the website in my article, but these all came out, the ones that we got forwarded between 8:30 a.m. and 9:30 a.m. So pre-market, I don't know how many thousands of emails were sent out, but so many to all of these people. And then sure enough, it boosts the stock up again, the next day. And this is just this amazing, there's been no fundamental development in the business. They haven't announced a big new contract. They haven't put out their results or anything like that. This is just, you email enough people this excited thing about, the stock, and the share price goes up.
Yeah. And this is, so yeah, I guess I don't want to talk my book too heavily here, Claude, but there aren't many of us in Australia, these publishers. So we've got a website, we call it Rask Media. A Rich Life does the journalistic side of things, the AFR, the Motley Fool. These businesses operate websites that you can visit, and it's basically the model is funded by subscribers. So there's an incentive there for that organization. Whereas many...
And so all of these organizations, I should say, have either at one point or another, or do some sort of advertising. So, for example, we also advertise ShareSite essentially, on our website. And if people click our link and try ShareSite and like it and pay, then we get a little bit, which we say. But that, us having an incentive to get people to buy ShareSite. That's not like a company paying me to say, hey, Claude, I'll pay you money. Go and put out, just email your favorable thing about us to as many people as possible. And it was favorable. This report, from memory, I can't remember seeing what the loss that the company made was, for example. I don't even know if it actually said it's losing money, but I didn't see what the loss was, or even what the market cap was, or even in many of the basics that I would, if someone asked me, oh, Claude, what's your number one stock for 2021, I'm at least going to say some sort of consideration like, oh, this is my number one stock at 6 cents, but now it's 14 cents. It's not my number one stock anymore. Do you know what I mean? Yeah. I didn't see them say on that, oh, we like this at 6 cents. They're just like, we've made a massive investment and everyone rushes out to buy it at 14 cents. Yeah, go on.
And I was also going to say, just on that you generally have to have some sort of risks. In investing, there are risks. That's the difference between putting money in a savings account and investing. It involves risks, and you'd expect that. But the second part of my point was that I've just named 4 websites. I can't, off the top of my head, think of. Well, Strawman's not really a publisher. It's just it's like a forum where you go to share.
Yeah, Strawman's probably like your next best source for company content that's not ultimately paid for by companies themselves.
Yeah,
that's what we're talking about here. Like, a company's like, I would like people to publish nice things about us. Well, there's ample ways for them to make that to happen.
Yeah.
But what they can't do is get somebody who has a long track record, or maybe they could, and this sort of corruption can actually happen. But what I don't think that we're seeing on Strawman, for example, is any of this. I'd be surprised. Maybe it exists, but you can't get some really good user who's got a track record of doing heartfelt things, and you can see what they've said over a year or more, and has a good ranking, and they've picked stuff and their track record's tracked by Strawman. If that person then is giving an opinion, that's probably not funded by the company. So I do think you're right to mention Strawman in the same sort of sentence. But you're right. There's very few outlets covering companies that don't actually ultimately get their funding from the companies, and that's who's paying, right?
Yeah, and that's it. So know the incentives. Go on.
Yeah. Yeah, no, I was. There are actually others that we haven't mentioned, but we won't try and do an exhaustive list because then we'll inevitably miss out somebody.
Yeah.
But I just should put on record. That's not everyone. There are other people that don't have that business model, and there is a lot of good.
Yeah, there are. There are many great outlets out there, but many of the ones that you probably know if you're listening to this, the stock market news and some of the forums. They're actually funded by the company, so they're more a PR business, not a business that's set up.
So, and advertising though, so in a sense though, anyone that takes advertising could be funded by the companies, but you just have to think, you have to look, just because they've got some funding from a company doesn't mean that they're actually having that funding influence their editorial. And I'll give you a good example. AusBiz did a great segment on this very stock, this OneView stock, and they just told the exact story. They said, well, this has gone up because a whole lot of emails have gone out, and that's the story, and that's what happened. There wasn't any fundamental news about the company. So that you can get the real story here, but most of the times, we kicked up a fuss about this one because it was super blatant and it was a story. It goes up 150%. It's almost like the methodology worked too well, so it was super obvious. And I mean, there's no downside for them. They've made great money out of it. But I think the key point here is we're going to see more of this. Look at the money they're making like this. We will see more of it. That's profitable, right? Yeah. Well, if you invest $1 million at 6 cents, email hundreds of thousands of people to Let me just read an excerpt from their email, okay?
Sure.
It's a subheading. It says an analogy that might help explain why we are so excited about one. So they just have the capitalized letters ONE because that's the ticker, right? That sinking feeling when you first get on an airplane and the plane is old and doesn't have touchscreens in the back of the seat. The next few hours are going to be awful. Imagine if you suddenly have to go to hospital, you get wheeled into your room, and that you see that your bed doesn't have OneView, ... Or worse, imagine if the hospital tries to put your sick parent, partner, or child into a bed without OneView. I personally wouldn't stand for it.
Yeah. So, yeah.
And get this. I don't know who so this writing, it's supposedly from the heart. But who is the I personally in that?
Yeah,
I'm not sure who it is.
I couldn't find the answer to that.
Did you see if they had
I didn't see a name.
Is there a character? There's no name on this. So there's no person that's willing to put their name and say, this is the thing that I wrote and emailed out to hundreds of thousands of people.
Okay. Yeah. And
that's the hint for you right there. This is what I'm saying. This is financial advice. This is coming from a financial advisor without a name.
Yeah. It's
as far as I'm concerned, it's hitting people's inbox.
Yeah, and this is the thing we talk about on this show and on our other shows a lot, and you do it at A Rich Life, is just take care about where you get your information from, right? And I guess a lot of the people listening to this know this type of shit goes on in the industry where if you're not paying, someone else is. So just you've got to know where the incentives are. But it's a thing. Maybe I won't say it's a problem. Everyone's got to make money. Everyone's got to make money. We're not criticizing companies for making money and for people making money from selling investment research or whatever, but just know if you're not paying, someone else is paying for that. And there is another thing here, which is kind of I want to tie this back to the company itself. So the company itself, and many small caps do this, they want PR because they want people to talk about them because they want to get attention for their company for one reason or another. But this company's gone out and made an agreement to get publicity, but the fundamentals of the business haven't changed, right? There's no, as far as I can tell, I mean, they've got, I think it was a few $100,000 or $1 million into their coffers. So that was maybe one fundamental change to the business. But other than that, there wasn't anything that I could see.
Well, it was a cap raising at a pretty low price as well, right? I think that they initially floated it at some high price, in the dollar range or whatever. So they've come down a long way, and now they're trying to tell the turnaround story, and just heaps of people ready to jump on board, and it becomes this sort of self-fulfilling prophecy where people reckon they're going to make a quick buck, and they're all jumping in. And you know what? The irony is that at 6 cents or whatever, actually probably, you could make a reasonable case that the company is undervalued. And if you put out a piece of work that sort of was an article and it sort of said, we reckon if these advisors said, we reckon this is great value at 6 cents, and we reckon it's good value all the way up to 10 cents, that would probably, be less intense than just this report about how you like this stock. And it's almost, if I was trying to make this company fly and get people to buy it at more than it's worth, then I would not put in any price that I thought was or where I had bought, if I bought at 6 cents. If I bought a stock at 6 cents and I just wanted to make it fly, I would just, never tell someone that I bought at 6 cents. And people just then knew they're not very savvy. They just see the share price going up and they just jump on board. They don't really know how to do valuations, and nothing in that piece of advice sort of points you to valuation. So it's just hot stock stuff.
Yeah, that's the thing. So we said at the top of the show, the small caps can be a bit like the Wild West. There are cowboys. So,
but then just sorry to cut you off, but just my last point on this company and this paid promotion that we saw is that that in their scorecard now that they're showing, that I also got a screenshot of, they had our entry price of OneView is 8 cents, and then they display the highest price as 22 cents, and then the far right hand side highlighted in as green, the highest return, as well as they also have the current price and the current return. But that price, 8 cents, that was that was basically the price that the shares closed at before they sent out their report. But anyone who bought shares in the report would have paid, after the report, would have paid above 14 cents. And so I don't know, but I wonder about all of these other companies that they say that they've put in their current portfolio of investments. Our entry price, I wonder if the people following their advice get their entry price, or if they pay more than double or something like that. I wonder how this all turns out for the people that are following this stuff. I don't know.
Yeah, it's concerning, to say the least. And I think as the stock research industry and just investment research industry becomes more fragmented because of these online mediums, companies listed outside Australia. This is a company with an AFSL, the one that published this.
Yeah.
So there are plenty that don't have an AFSL, that don't understand the rules in Australia, but yet publish research into Australia.
I think also the lesson here is, just because it's someone has an AFSL doesn't mean that they can't be giving you, conflicted advice. These guys disclose that they say they may have conflicts of interest and everything. We're not suggesting they've done anything wrong, but we're just letting people know that this is what people are allowed to do. That seems to be what it is all good.
Yeah.
For AFSL holders.
And listeners can jump on A Rich Life and find out more about what exactly is going on. One final piece, mate, that we wanted to talk about is just management selling. So sometimes there's a signal that people get from a manager who sells shares in the company that they run. And we've got a good example in Pro Medicus, and probably a not so good example in Monash IVF. Yeah, I mean, maybe we can end on a good note. So maybe if we start with Monash IVF and then go to Pro Medicus.
Yeah, okay, why not? So Monash IVF is a story that I like to remember because a lot of the time when you have someone, a director or a founder or maybe CEO selling shares, a lot of the time that's not really a useful signal that the end is nigh. But in the case of Monash IVF is a time when actually the final trigger for me was insider selling, and I was glad it was. So Monash IVF, they do their fertility clinic essentially, and they listed around the time. There was another fertility clinic as well, Virtus.
Yep.
And it, after listing, it had sort of a decent-ish performance, and I had it as an active recommendation for Motley Fool at a certain price, and it did its 2016 annual report and showed revenue up 35% revenue up 25% and profit up 35%. And then what we saw in September was the CEO sold 580K worth of shares, and a board member who was essentially almost like a founder, but he was the medical director of the Adelaide IVF clinic that had sort of come together with the Melbourne one to form Monash IVF. And he sold over $2 million worth. And then in November 2016, the company said it was expecting 7% NPAT growth for H1. So it was still saying it was going to grow profit, but slower now. And then in May 2017, the CEO, who had been there since the IPO, resigns just to take a job elsewhere, basically. Mm-hmm. And so I said before that selling the shares was a trigger. It wasn't. It was just part of the trigger. But what had happened is previously I had seen in too many small caps, I had seen, CEOs sell shares or insiders sell shares and CEOs quit, and then just things start going wrong.
Mm.
So given that the valuation was already sort of stretched, when the CEO resigned, I sort of made the snap decision to just say, oh, I'm going to just write a sell recommendation, basically, which was, just had to say, look, already I was feeling a bit iffy about it. They've had some insider selling, the valuation's higher now. It had gone up after these good results. And so, just going to get out and be safe. And I was lucky that I did that, and I followed that heuristic, even though I thought, if this recovers now, I was scared of looking silly. But yeah, basically, not long after that, the CEO resigned, and then that was in May, and then in June, one of the star doctors, one of the star fertility specialists who worked at the Melbourne clinic, announced that they were leaving the company. And then this was followed by further bad press in the AFR saying in July that doctors weren't that happy, and basically for this podcast, and so eventually I just stopped looking at it, but it sort of imploded right after that, right?
Mm.
And it had been the CEO quitting that had finally and plus the selling as well from insiders that had combined to make me think, oh, look, I don't have super high conviction on this. I don't have a whole lot of evidence to suggest that I'm comfortable with management. I don't even know who management's going to be. I feel like the signals are that I feel almost management was telling me things that are going to get worse just by their actions.
Mm.
And then sure enough, I looked at the results for those H1 2017 results, which were kind of the ones that were about to happen when the CEO left. Net profit was 15.2 million. In the last half year results, net profit was 14.5 million. So essentially, since that time, the company is still sort of down. So that, and its share price is down as well. And look, I don't have a view on the company now. I don't own shares, and I stopped following it years ago. But it's just an example of why, to me, I'm not saying you should always sell your shares if the CEO quits and sells shares, but it does make me wary. And sometimes you can be right to be wary.
It's an interesting, I guess we kind of, there is a straw that breaks the camel's back. And in this instance, it was almost like the fundamentals confirmed, or management confirmed fundamentals, because the fundamentals seem to be turning at the same time as you see a sell from.
Yeah, exactly. So
it's multiple signals that add up to be that red flag, right? Conscious of time, mate, but one more that we can end on a positive, which is a company that it's a company that I know, which is Pro Medicus. We've had Sam on the show before talking about in the business's genesis and where it is today. How would you say contrast what you just said about the sell decision and the ripple effect of things that happen after the flow-on effect, I should say? How would you contrast that with Pro Medicus?
Well, I think actually the story of how I've looked at management of Pro Medicus, which does partly answer your question, is actually quite interesting, because Pro Medicus is an example of what pushed me towards trying to learn more about people and just focus on what they do, can actually give you good signals. For me, it was important because I didn't buy shares in Pro Medicus until I actually saw the CEO present at I think it was a microequities maybe concept. I can't remember what it was now, but one of those investor forums where CEOs come and speak. Yep. And I was looking at the stock while he was speaking, and I could see the last few notices were basically, him buying shares in the company and him explaining the business to me. It was just so compelling. And I was like, this guy's literally probably bought shares yesterday and probably going to buy shares tomorrow. His money is actually where his mouth is. Him and sort of his co-founder friend still owned more than 50% of the business. So it very much looked like they were in control. So I knew that I would be trusting them. But also I felt that he was trying to stand up there and say, hey, like, we've been trying to knit together this for quite some time, and we've literally just won our first big contract with this sort of new product we've been working on, and that makes it an exciting time for the company. And, if I saw that now, I would just be like, oh, man, I'm going into massive position. Like, I wouldn't be able to help myself. But I looked, of course, I did the research on the industry and did all the usual due diligence stuff that you do when you think it's like, it's not enough just to see, the CEO likes it and is buying shares. Yeah, sure, that's enough to make me have a look. I definitely am not saying that is enough on its own to buy shares in a company. I then looked and checked out, and basically what his presentation did was prompt me to look at the movement of deconstructed PACS, picture archive communication systems. So I won't cover the whole PME business as we both talked about it plenty of times elsewhere. But yeah, that was that sort of like initial impression. Like, for me, looking at director trades and director holdings, that's part of management assessment, obviously. So that's why we've been talking it so much. And so that sort of helped push me into it. Like, obviously many years have happened after that, and the share price gets up. I can't remember exactly, maybe around $6 or $7, and they have the AGM, and I think it was in the AGM. I can't remember exactly when they did it. Maybe it was with an annual report, but at some point they put out an announcement that said the two founders are planning on selling, I think it was 3 million shares each in the next few years or whatever. Yeah, and then the first time they sold shares, it might have been around, I can't remember. Do you remember, mate?
No, I don't remember the first time, but I remember it being one of the times was recently. I think this was the final installment. I could be wrong.
I think this was the final lot came out.
Yeah, the final lot of the $3 million.
Something dollars.
Yeah, it's $43.60 when I'm looking at it right now. So yeah,
but I think they might have sold at 46 even, did they? I can't remember. I'm pretty sure they sold at 36 million in the last at $36. So they got they sold 36 million each.
Anyway, it was well scripted, right? Like they told you in advance this is what's going to happen.
Yeah, so that was really calming, but also, it did often come down after they sold their shares. But then each time they sold it was high. I think, let's just say for the sake of the argument, they sold it around 7 or 8, and then they sold around 30 something, and then they sold around 40 something. So each time it was still going up when they sold more shares. But every time the market did, when they sold shares the second time, lots of people saying, trying to make it out like, they're dumping shares as if that means they don't have conviction or whatever. But I mean, fair enough. They own more than half of the company. They were selling, maybe it wasn't 1 million shares, maybe it was 1%. I think that's might have what it been. So they still, between the two of them, held control of the company. And the share price was on a massively generous multiple that the market loves it now. So I don't think it means that they don't believe in the business at all, is essentially what it comes down to. You may argue, I also sold some shares in Pro Medicus as well around current prices. So, I'm not saying I think it's cheap now and I'm buying.
I think the signal here is twofold. So on the one hand, we know from the examples that we've covered is that management can give you pause for thought even before you buy a company, while you own it, and maybe even after you own it. But then the other thing is that great management can be a very strong signal that you can have conviction. You can increase your conviction when you know that there's a good operator. And whether there's a whole list of things that go into making someone a good operator and a good management team at large. Some of the things that I've talked about, Claude, are in terms of communication, having a management team that is kind of transparent in the first place and willing to deal with unpredictability when you ask questions. Like, are they prepared to let you ask questions in the first place? What kind of questions are they going to set up on the call? Skin in the game. We mentioned at the end there, we talked about Pro Medicus. Even after they sold, just for people that don't know, they still had, I believe, over $900 million worth of shares. So, talk about significant skin in the game. You mentioned that, management teams can be a cause for a turnaround in their own right. And if you find a good horse that has a poor job,
a change in management has the same potential as an inflection point in like a business development. That's what I'd posit.
Yep. And then go on.
Go on with your summary. It's excellent.
One more would be that management can confirm the fundamentals of a business, whether that's good or bad, and probably vice versa. To be honest, like
So another point that I don't know if I said explicitly, but I think belongs in this summary is like look at how cheeky are the metrics and stuff they put forward.
Yeah.
If they are reporting, say, underlying profit, which is after currency movements, do they make it equally prominent when currency movements have gone for them as against them? Or do they sort of take advantage of it when something goes their way and put that forward? Do they report on free cash flow at all, or do they just report on underlying EBITDA? Free cash flow is a more quality metric in my opinion. And with recurring revenue, do they simply report recurring revenue? Do they report annualized recurring revenue? Because recurring revenue is how much genuinely recurring revenue did you just book in the half. Annualized recurring revenue is usually like we're annualizing the most recent month, so that's more sort of aggressive. And then contracted annualized recurring revenue is sort of a super airy-fairy number that's like we've signed contracts that will result in us getting this much annualized recurring revenue at some usually unnamed point in the future.
Yeah. That's a good way to summarize that.
So looking at how conservative or bullish management are, do they expense software development? That's a classic one that you and I would encounter sometimes.
Yeah. The final one is I prefer management teams with technical skills. You do too, by the sounds of it. So,
absolutely. Yes.
Yeah. And I mean, this is just cherry picking, so I keep that in mind, survivorship bias, all that. But in the case of Pro Medicus, we had a medical doctor and we had a developer come together to create a company that creates medical software. So it's kind of a match made in heaven. So that, again, cherry picking, but something to go on. Claude, there's so much we talked about in this episode. An hour and 17 minutes, mate. Wow.
I think it's a good time to wrap it up then. But it's been really fun. Thanks for having me on. And yeah, this will be something that I sort of can even listen to myself to remind myself of my belief that really just thinking about and getting this is my last final lesson really on this subject, which is that it is not just a matter of how much you study a company, but it is actually partly about how long have you followed the company's story. You can come to a company and look at its history and read its history and do your best to imagine what your expectations would have been 4 years ago when the CEO said whatever it was then, so that you can match up with what happened in the future. That's a good technique, but nothing beats really following a company in real time. And I believe because humans are so complex, we do take, you might make a really good CEO might make a bad impression on you the first time you sort of encounter their company for whatever reason. And people take time to like really figure out whether they do trust each other, essentially. And so for that reason, I think that the most important thing in terms of judging management is just following along in real time with some companies that you're interested in. Because that gives you an edge that no one can really replicate the exact experience as well. So that's a really good way. You are a person that goes about your life making judgments about other people and who you want to trust all the time. Like we all essentially have our own methods of doing that. And they're usually similar, but you can use those everyday life skills if you just follow a company and get to know it and get to know the people managing it. And that can be very useful exercise. And it's something I do a lot.
Great. Well summarized, mate. Awesome. So Claude Walker from A Rich Life. I'll put links in the show notes to Claude's website. Check him out. You can subscribe to the free newsletter. You can get hopefully you can get on the list to join his supporters program too if he lets us in. Claude, as always, mate, thanks for taking the time out.
Thanks a lot. Thanks, Owen.